We live?
We are live.
Hello guys. First off, Happy New Year.
Yes.
We haven't seen you since last year.
Gosh, time does go quickly, doesn't it?
Did you hear the joke that I tried to make in that? I haven't spoken to them since last year.
Yeah.
So we are starting season 4, episode 1 today.
Yeah.
Um, so it's just a fresh start off to the new year. And I hope everyone's had a lovely Christmas break and New Year's as well. And we're back into the grind mode. So our topic of discussion today is challenges with life insurance from an estate planning perspective.
Definitely.
So we're just going to really just jump straight into it. We will start off with large policies.
Yeah.
Richard, would you like to expand on that, please?
That's actually a good point. So let's define what a large policy is. In my definition, it's a personal definition, it's my opinion. So once we go over, let's say £300,000, maybe on the safe side, £250,000 for a life insurance policy, I'd consider that large. Now, the significance of that really comes down to inheritance tax planning. And obviously, when you're speaking to financial advisors, unless they're qualified to give you inheritance tax advice, they're not going to talk to you about this type of stuff. And inheritance tax is really coming down purely, well, there's two ways for you to look at it. If you have the policy and it's not in trust, and we'll come on to trust in a minute, obviously that will add to your personal estate. And if you've got a large enough estate as it is, then it's going to increase your wealth, which then increases your liability and potential to pay inheritance tax. So that's the first challenge. But putting it into trusts, which is always a good thing, will obviously reduce your estate, but the trust rules still apply. And most people don't understand the trust rules. So it's important that you do understand how trust works to at least a modicum level, so you can make an informed choice, or at least speak to professionals, speak to us further, to get further advice about what to do if that's something you're concerned about. So the biggest challenge with a large life policy is something you probably heard me talk about it before, a nil rate band. That's the level of, or the cap. So once you exceed, your wealth exceeds that level, you'd be subject to inheritance tax. And with trusts, that level is capped at 325,000. So you can see what I'm saying. If you've got a policy bordering 250, 300,000, etc., we're hitting a challenge. And one thing about trusts is that there's 3 ways that you can potentially have an inheritance tax liability, or the trust will. So the first one is obviously an entrance fee. The second one is the periodic charge, which is reviewed every 10 years. And the third one, which is if the trust is ever shut down, if the asset or the value of the trust is more than 325,000, then there's a potential exit charge as well. So you don't get that advice, all right? And I'm not going to go into too much detail now because I don't want to confuse everyone and make it go over your head. But ultimately, you potentially that policy, if it's quite large, number one, could attract an immediate 20% inheritance tax fee. So you're thinking your family's going to get a large lump sum, but they'll get 20% less than what you thought. The tax would have to be paid on that. Talk about anniversary charges. We could learn to maybe mitigate or delay it if you know what you're doing and getting the right advice. Otherwise, that could be another surprise cost to the trustees, and that could obviously affect the beneficiaries if you're not getting the right advice. So these things are important. As I said about the exit charge, again, if for some reason the trust needs to be shut down and there's large funds in there, if the advice wasn't given, or you weren't aware of it, or trustees weren't aware of it, that could cause a problem. So large policies, yeah, I get it, they're good, but there's a ways and a means to set them up if you know what you're doing up front. So that's really what I'm trying to highlight, and that's why it's a really important topic to discuss.
Okay, thank you. So what about when it comes to joint policies?
I don't like joint policies. I think people think they're really efficient, but I don't think so. Obviously, we're not giving financial advice. I want to make that very, very clear. But from my understanding, there's not really a huge difference. Again, that's just my opinion, between the price of a single policy times 2 versus a joint policy. But the main problem is inheritance tax planning. And because we don't know who's going to die first, it's very difficult to plan. And that asset is going to be in someone's estate. So if you're not married, and you're with someone, that's a problem. If you are married, again, we don't know how that's going to be panned out or planned properly, so we can't put it in a trust initially. Life insurance companies will say that it's in a trust, but that trust does not start until someone actually dies and you survive 30 days after. Normally it's 30 days after the death has occurred, and then it will set up a trust for the person who survived. To me, that's not the best type of planning, especially from an inheritance tax perspective. So you really got to be very careful of the type of policies that you're having. I always say just go with single policies, and then you're getting double the money for probably double the value for the same outlay financially. So joint policies, I personally don't like them. And they're a nightmare when it comes to inheritance tax planning. So that's why just be very careful. If your estate is large or building up, especially as we, increasing our wealth over time, just be cautious. And the older we get, you're probably aware policies are more expensive. So let's get it right the first time around rather than have to kind of suffer the consequences later on. Or maybe if an illness took place, you can't even change the policy, so it's too late. So really important that you get the right advice around that.
Thank you. And also, can we touch on a bit on considering the whole of life assurance versus the term insurance?
Yeah, I mean, term assurance is very popular, very common, whether you do it yourself or get it via a broker. But it's a term assurance. It lasts for a period of time and it will expire. That's why it's much cheaper. And if you outlive your policy, then it's like, well, okay, it's done its job. But if you outlive it and a situation occurs, then you're kind of stuck. I don't think whole of life insurance are talked about enough. Again, we're not giving you advice here, but I'm sowing a seed that if you are looking to sort out some type of life insurance assurance, ask the question of your advisor, well, what about whole of life? Now, I'm going to tell you now, yes, they are more expensive. I would probably say speak to a broker or a professional rather than trying to search it yourself online, because the small print is very important. I'm not talking about relevant life policies, I'm talking about personal life insurance policies. And again, if your life assurance is probably one of the best ways to mitigate against inheritance tax liability. So again, speak to a professional to help you get the right advice, because there is a big difference. And obviously, the earlier you get it, the lower the price, the better the planning. Again, trusts are important, but the advisor can give you the best advice. A competent advisor will give you the best advice for you to make an informed choice. And again, from an estate planning perspective, which is what this is about, speak to us, speak to a competent estate planner who can help you further with that planning, with obviously a lot, or even speak with your financial advisor or professional advisor regards to the type of policy you're going to get. It's really important. I can't stress it enough.
Thank you. And also the transfer of wealth in regards to the inheritance tax.
Yeah, I mean, we are strong believers. Our whole vision and our mission, our purpose is to allow the families to be empowered to understand and how to set up and continue a generational wealth perspective for their loved ones. And life insurance is probably one of the most safest and best ways to achieve that. So when it comes to generational wealth, when it comes to understanding why life insurance is a useful tool, trusts definitely are involved with that. But if for some reason you're not running a business, or even if you are running a business, just to mitigate risk, life insurance is probably insurance is probably one of the safest and easiest, less complicated ways for an individual to plan for their loved ones. And if you combine that with the use of a decent discretionary trust, you can really almost operate like your own bank if you get it right. I'm not talking about this American concept with infinity banking. I'm not talking about that. I'm just talking about once it's set up, then for generations, your family could really benefit if it's done properly. And so life insurance could be a very positive way to build wealth, attract wealth, and to sort wealth for your family members, especially if you've got trustees and custodians to wealth, to make sure that the family wealth is passed down from generation to generation. So it's really worth inquiring more, reading more, finding out, educating yourself more about that. We've got our do you want to talk more about the Once Academy and the stuff that we have to
Yeah.
help educate people?
Yeah, we have our Once Academy. We have been we've got 2 posts up at the moment, so I'd say to check that out. Our Once Academy has a lot of information covering things like trusts and inheritance tax. So if you're here and you're finding this useful, then it would be a good idea for you to also head over to our Once Academy. It's still a work in progress, so if you'd like to see anything up, but please do let us know. But yeah, if you'd like to know a bit more in regards to the inheritance tax and trusts, have a look and head over.
Yeah. What's the best way for them to access that information?
I'd say the best way, we can link it with this live.
Yeah, definitely.
But I say the best way is to head over to our website, and then on the top in the tabs, what do you call them? The headers?
Yeah, the menus. Yeah,
the menus, you should see it over there for Once Academy, and it will just take you to the login page. And if you're not already got an account, you can just sign up.
Yeah, it's totally free as well. So
yes,
it's a resource that we want to help you educate yourself. And if you're interested in learning more about trusts, do you want to share a bit more about? We got the workshop, we've got the ebook, we've got a whole lot of stuff.
We've got a few stuff on our stand store for you to check out. We have an ebook. It's about finishing well. It's an ebook and workbook together. They go hand in hand. So it would just be a good, I would say if you have some spare time, just go through it and like plan out yourself as well. We have our other ebook regarding trust there, previous workshops. I would say it would be really great to check it out. And also if you think it would be helpful to someone else, I'll also share it with them as well. But yeah, we have got a few resources there for you to check out, which we believe would be very helpful.
Definitely. No, I think that's fantastic. So yeah, I think that, I don't know if it concludes for today. Is there anything else you feel we want to share?
I think we've gone through them. Yeah.
Detail? Okay.
Yeah, but if there's
Brilliant.
anything else you'd like to see, please don't hesitate to let us know or comment down in the comment section. At the end of the day, we're here to help you. So
fantastic. All right. See you on the other side next week. Cheers. Bye.
Bye.